Hi everyone, I'm back. It's Mark Lefevre. We've done a couple different valuation models, and we've done it, really a lot of the valuation models that we learn at level 2 have to do with public company valuation. We are external analysts, we go out and we gather information, we can look at market comparables, relative valuation multiples. It's all pretty straightforward. However, when we switch over to private companies, firms that do not publicly trade, it becomes a bigger challenge. There isn't as much uniformity in the way that we value these types of securities. The risks are very different. The adjustments that we have to make to get these valuations done are significant. And it's just a different process. So where this reading comes from is the new curriculum came out in Equity in about 2002. And they redid the book. And recently they added in a whole new chapter at the end of that book called Private Company Valuation. And so the one thing I would encourage you as a candidate to do is to recognize that anytime there's new material that comes into the curriculum, they tend to kind of start testing it and they increase their exposure to that slowly over time. And so I just want you to recognize that it's a fairly recent phenomenon to have this chapter in the curriculum, but to probably spend some time on it since it is at the very end of a new book that they added a couple of years ago, and it's very different from the traditional valuation stuff that we've dealt with before. So a lot of the material in here you've seen before. I mean, there's nothing really new, but it's just a tweak to go from public to private. Okay? So the first slide really wants us to compare and contrast what it's like to value a private company versus a public company. And what I want to try to highlight for you as we look at the next two slides are what are the company-specific factors that we need to be looking at. Well, obviously, if you think about the stage of the life cycle, when we talk about public companies, we're a little bit further down the stage of that life cycle. We're kind of in the rapid accelerating growth, the mature stabilization, or even in the declining stage with a public firm. With a private firm, we're back down in that very early venture capital stage or prior to going public. So we're in a different stage. Also, we're at a different size of the organization. Public firms can be huge with thousands of employees. Private firms typically are very much smaller. They haven't grown nearly as quickly. And with a change in size, that implies a difference in risk. Okay, so size can imply risk differentials. We know from what we've done before that there is a small cap risk premium, and that applies to private firms as well. The other is the quality and the depth of management. Now, I'm not saying that private company management is any brighter or smarter than public company management, but there might only be one manager. So the depth of the management team for a private firm could be a whole lot more shallow than the layers and layers of management levels that you might have at a firm like General Electric. And obviously, public company management might have a little bit more experience in dealing with the capital markets and communicating with analysts and providing information to the market, whereas a private manager may not. Okay? Now, the other thing then is, if you look at the next bullet, is management and shareholder overlap. In a private firm, management, one or two managers, might actually own the entire firm. And so there is shareholder and management overlap. Whereas if I'm a manager, excuse me, in a public company, certainly I've got ownership. Maybe I've bought shares through employee stock purchase plans or grants of employee stock options, but I don't have a significant controlling ownership component. So there's a difference there. Also, the short-term investors. Usually when you take a private investment firm, they're in it for the long haul. They're management, they own the firm, they're in it for the long-term basis, where public company investors are usually short-term. They come in and out because of expectations, because of market valuation differ from its intrinsic value, and the holding periods are not as long. So there's a mismatch between the two as well. We've kind of alluded to the quality of information. Obviously, if you're a public firm, you have to file SEC documents, GAAP-reported financial statements, or adherence financial statements, and so there's a whole lot more communication with the market as to what's going on with a public firm. Private firm, they don't have to meet any of those standards. And lastly, taxes can be a big difference too. Public firms are actually being taxed at the corporate structure in the tax code, whereas private companies are probably paying taxes either as a limited liability company. They can be a Schedule C. You don't need to necessarily know that, but they might be taxed at the individual level, or just a sub-S corporation, but not as usually a C corp, a major level corporation. So there's just difference in taxes. So again, these are company-specific factors that can differ between a private versus a public company. Now the next slide talks about stock-specific factors. Okay? Now these are more external factors, whereas the company-specific factors were internal factors. That's another way to kind of differentiate between the two. So obviously a company who is publicly traded has its shares being traded in the public capital markets, therefore it has a whole lot more liquidity. If you have a privately owned firm, it's going to have a lack of liquidity, which sometimes can create a difference in market value when the shares aren't publicly accessible and tradable in the capital markets. So there isn't a market for that security. Therefore, it has what's called a lack of marketability or a liquidity discount relative to public firms that trade. And there may be restrictions on the liquidity. You know, there may be a provision in the Articles of Incorporation in a private firm that says that the largest shareholder may need to give a certain amount of permission for other shareholders to trade their securities, so there might be restrictions on the liquidity within that firm. And obviously, if you've got somebody who's developed their company and grown their company and owns their company, there's going to be a concentration of ownership or therefore control because they can drive and move the company in a strategic direction different than others. Whereas in a public company, to try to own more than 10% of General Electric would be very difficult. So the concentration of control is diluted more so in a public firm, much more concentrated in a private firm. And again, these are all external factors that describe the difference between private and public firms on a stock-specific basis. Now, one last item on the difference between private and public is obviously there's a lot of heterogeneity with private firms, meaning that private firms, even amongst themselves, are very, very different. The greater variety of risk and where they do their business geographically, what industries they do it, what products they have, the type of management that they might have, and as a result, there's also a greater variety in the valuation methods. Maybe the firm doesn't provide any positive cash flows, doesn't pay any dividends. Maybe its capital structure is all equity versus any kind of a debt. So there's just a greater variety of valuation methods that a little bit later within the slides that we're going to have to talk through. So again, even within that subset of private firms, lots of differences. So the next question we need to address is, what are the reasons for valuing private firms? So, you know, you can certainly as a portfolio manager look out and say, all right, I want to own in my portfolio equities, I've got bonds, I've got alternative investments, and so I'll look at publicly traded firms. Well, the question is, why do we want to value private firms? If they're not available to us, why would we need to do it? Well, obviously one of the most important reasons is if we go back to that company life cycle, we go back down to venture capital stage investing. So VC firms, if they want to value a firm before it's gone public, they need to use private company valuation methodologies. And also, if we go from the venture capital stage and start to look at taking the company to the capital markets for the very first time through an IPO, we need to be able to value that firm on an IPO pre-market trading basis. Also, there may be an owner within the firm, a manager, who for whatever reasons has decided he or she doesn't want to be in the business anymore and they want to sell it. So firm sale. Lastly, you might have to go through some bankruptcy proceedings. Maybe for some reason the firm has not survived the economic downturn and as a result needs to go through the bankruptcy courts, and so you need a valuation of what the firm might be there as well. Now there are lots of firms that are privately owned but also owned by their employees. I think they mentioned Bechtel was one of them. I know Kiewit in Omaha, Nebraska is a private firm. UPS, before they went public, was a private firm. Koch Industries in Wichita, Kansas are also very, not Coke as in Coca-Cola, but KOCH is a different firm. These are all privately owned, and sometimes the management might grant employees ownership. And so when they do that, employee stock ownership plans, they have to come up with a valuation. And so they come up with what's called stock-based compensation plans based on the value of that private company. So many different reasons, transaction reasons, that we would want to value private firms. Now, other reasons that we might value private firms, the first one that we noticed on the last slide was for transactional reasons. There's two additional reasons, compliance and litigation. With compliance, they might actually have to meet certain types of financial reporting. So if they're granting options to their employees or ownership within the firm, they need financial reporting in order to do the valuations. And also, according to IRS regulations, they need to have some financial statements to back up the taxes that they're going to have to pay. So again, those are just compliance reasons. Now the last group here is basically the litigation group. That's the kind of the uglier side, just as anything else. You don't want to ever be in court or with a bunch of judges, with a judge and a bunch of attorneys, but there can be shareholder suits. Maybe the firm has done something wrong. Maybe environmentally they've broken some laws. So as a result, they may need the value of the firm with a shareholder suit. Also, there may be damage claims against the firm. Maybe somebody got a cup of coffee that was too hot at some coffee shop that's owned privately, and maybe they have a franchise, and as a result, there may be a damage claim, and as a result, they need a valuation of the firm. They may also have to assess lost profits. So if for some reason the franchise incurred some kind of a disaster, maybe they had a hurricane or a tornado that destroyed a couple stores, they have to figure out what those stores were generating as profits so that when they can go make a claim on the insurance, they have something to stand by that, to support what their claims might be. And lastly, you might unfortunately find that there might be a business owner who has grown a business and has a privately owned firm, and one of the other partners in the marriage decides to file for divorce, and they need to split up the value of that privately held company. So unfortunately, litigation then becomes a part of that divorce. We're trying to figure out what the value of that ownership in that firm might be worth. It's certainly not a pleasant experience to go through. Okay, now they throw a bunch of different definitions of value at you. And so you probably want to take just a few minutes to go back into the core curriculum and kind of get an idea. Now, all of these different definitions kind of have a beginning common theme. And the value is defined as this, that you have two willing parties willing and able to exchange at arm's length, who have knowledge and who have done diligence and understand what they're getting into, to exchange the different assets between one another. That's kind of how they start off the definitions of value. So whether it be fair market value or fair market value for financial reporting, what that's really saying is that accountants have a different hierarchy or way of looking at fair value than other traditional measures, maybe like a court sense of fair market value for litigation. Now, market value is what you would actually observe in the marketplace, where market participants as an aggregate come in with supply and demand and determine the clearing price in which an asset could be cleared. But we're dealing with private company valuation, so we can't always go out to market value to get that, but we can look to comparables and imply from those market values what the value of our firm might be. Now, investment value is basically the idea that an investor makes an investment into an asset, what it's worth to them as an individual. Okay? Now, let's just use an example. I might say that I'm a collector of baseball cards, and there may be some kid who's got Hank Aaron, a very famous baseball player, baseball card. Well, to him, he doesn't understand the baseball card business, and it might only be worth $1 to that kid. But being who I am, I recognize as I'm a collector, that might be worth $1,000. I have no idea what it would be worth, but it might be worth $1,000. So the investment value to me is much greater than to somebody else. It's what it's personally worth to you. Now, the intrinsic value we've talked all through equity valuation about. It's just the present value of all the future cash flows discounted by the appropriate discount rate that reflects the risk and the timing of those cash flows. So the point of all of this is that there are many different definitions of value. And you might want to spend a little bit of time going through the core reading or through your review notes to be able to at least identify the subtle differences between one to the other. But the common theme, two willing parties who are informed, who haven't been encouraged unwillingly to participate, but are willing to exchange that asset in an arm's length transaction. Okay, so the different approaches that we have to valuation. There's basically three that we're going to be talking about. And you've seen these all before. One is the income approach. We basically take the present value of all the future income, which if you think about a private firm, could be a very big challenge trying to figure out if they have a normalized earnings stream, if that earnings stream is going to increase or grow, or any of those other factors that become a little bit more difficult compared to a public firm. Now, market-based valuation measures, we're going to look to comparables, price multiples of either other public firms, transactions that have been done, or other market comparable methods to help us derive or infer from other transactions how to value the existing assets that we're looking at. The last method is what's called the asset-based approach. We're basically going to take the assets that are reported minus the liabilities and try to figure out what really the net worth of the firm might be from that standpoint. And so the important thing to remember is, again, all through our process, you have to consider at what life cycle stage we should be considering all of these, because it makes a big difference. If you're more in a mature stage, the present value future income will be a little bit easier as you are using like a dividend discount model with a constant stream of income or dividends, as we do with the DDM. You've got a constant growth stage. Whereas the market multiple approach might be a little bit more useful if you've got other recent transactions that are similar, that are in the similar industry or similar characteristics of the business line that they're in. It can help you. The asset-based approach might be a little bit more helpful in the earlier stage of a company's life cycle. Okay, so let's talk about that income approach for a moment. And you think about a business owner that owns his own business, there are going to be some items that flow through that business that may not normally flow through a publicly owned firm. Okay, and so what we need to do is we need to normalize these earnings, basically remove non-recurring or unusual items, in a sense. I'm going to use the first one as kind of a borrowed term here, but we need to normalize it. Make it as though if it was a comparable public firm, what things could we not incorporate in there? So unusual or infrequent items might be items that are of personal nature to the business owner. For instance, discretionary expenses. They might have lunch and talk with their coworkers about what's going on in the business, but then write that off on a business expense basis, where if two employees in a publicly traded firm were to go out at lunch and talk about something they were doing that day at the office, they couldn't expense that through the expense system. So these are discretionary expenses. You might also find the business owner taking a larger preponderance or a higher level of compensation than a comparable public firm. So these are what are called non-market compensation levels, where we'd have to kind of ratchet down what that expense might be and therefore increase the potential operating income from the firm. Other types of personal expenses that might flow through there, maybe they lease a vehicle for their personal use. They flow that through their business, and as a result, lowering the operating income. They might have some property. Maybe they have a warehouse that they own, and they actually hold some of the inventory of their business in their warehouse, and maybe they are able to charge the business a lease expense as a result of that. Well, if it was a publicly traded firm, they probably couldn't do that with any of their employees, so you'd have to make an adjustment. And if there's other types of non-market related expenses that are flowing through the firm, they'd have to make some adjustments there as well. Now, the strategic versus non-strategic buyers, it all depends on who is actually buying the firm and what kind of expenses they would be including and not including. It just depends if it's going to be merging with their existing business or if it's going to be a standalone business and what items could flow through. So that's kind of what we need to work through on the normalization of earnings adjustments. Other certain issues that we deal with in the cash flow estimation of a privately owned firm is that controlled ownership perspective. Remember, you kind of have this continuum. As you start to purchase more and more shares of an organization, you start to incur what is called a control perspective. And that control perspective is very important because as you acquire more shares and gain control, you can help to determine strategic direction, hire and fire management, decide whether to retain or dispose of certain strategic assets, and you have a lot more input to how the management is actually being run within the organization. So controlling versus non-controlling interests will have different values. Obviously, the more control that you have, the higher the value of that ownership because you do have privileges associated with it. The other thing when we're dealing with private firms and cash flow estimation is we need to run through many different scenarios. Because a public firm may be more diversified in its lines of businesses and therefore different economic cycles and peaks and troughs in the business cycles may not impact them nearly as much. But with a privately owned firm, lack of diversification in its business lines might actually be hurt more significantly by business cycles. So scenario analysis would be very important. Life cycle stage and trying to understand where they are in the early stages of the rapid accelerating growth, the entering the mature and stabilization phase, again, helps with an understanding of the cash flow estimation. Obviously, firms that are along the top of the curve, more steady, sustainable, estimatable cash flows, where very early stage firms may not be generating any cash flows whatsoever. Management biases, again, can come up. They certainly a manager of their own business is going to try to estimate that their cash flows are greater than they otherwise would be. So we have to look for some of those biases. And lastly, the capital structure changes. We know that firms that are very early in the life cycle stages have a lot more equity investment, very little debt. But as a firm grows and starts to mature in that company life cycle, it's going to take on much more debt to lower the weighted average cost of capital. So we need to look at the different capital structure changes and the challenges that as a cash flow estimation we need to tackle. Okay, so in the income approaches, we've kind of seen these before. We have a free cash flow estimation model, a capitalized cash flow model, which is very much like a dividend discount model. You just have the cash flow in the numerator and you capitalize it, given an R minus G in the denominator, and then an excess earnings method, which in a way is very, very similar to residual income. It basically says, what are the economic profits that you have, and let's capitalize those. Or are there certain items on the balance sheet, or let me rephrase that, are there items that are not on the balance sheet, otherwise known as intangibles? Again, if we develop something internally, it may not be able to be capitalized, but we know it generates value. We have to figure out what those excess earnings that are being generated by that. And there's a couple different examples that we can work through to show that. Okay, so the free cash flow methodology that we've seen before, all we really do is take the present value of all the future cash flows along with a terminal value. Remember, when this growth slows, we come down to a terminal value, and we present value those all back. And we have at least a couple times looked at, well, the terminal value in the constant growth model. Let me get this little pencil here. If we look at this first bullet point, the constant growth model, you basically take the dividend or the cash flow. Maybe we should use, let's just erase that. Let's use cash flow at the last period before the slow growth occurs. Let's say it's in period N. We're now going to grow it by the 1 plus the slower growth rate. And we just divide it by R minus G. Okay? Then what we do is that is a terminal price. And we typically present value that by 1 plus R. Gosh, my contacts are getting dry. Back by N periods. We add that to the final period cash flow. This is our sales price or terminal value, and we bring it all the way back. We've seen that many different times, whether we were dealing in the 2-stage model, the 3-stage model, the cash flow models, or otherwise. Now, the price multiple approach, we just take maybe an average PE. I'll just look down here so I don't scare you so much. A normalized average PE times the earnings per share forecast, 1 plus G, out in year N. So whether we do it this way or we do it this way, we get the same terminal value. Okay? Now, the one thing that you want to make sure that you don't do is you have a potential for double counting high growth. So there may be growth in one stage and growth in another stage, but you don't want to double count. Remember, we've got 2 different stages in the 2-stage model. There's a high growth stage right around in here that moves to a slow growth stage, GS, slow growth, GS. And you don't want to count the growth on both sides, particularly by increasing, where they talk about the double counting of growth is increasing the growth on here and the growth in here. Remember, this is P0. It's a historical rather than, you do not want a piece of 1 because that double counts the growth here and here. So that's what they're talking about with double counting the growth. Okay, so the capitalized cash flow methodology, I can't imagine that you haven't seen this before, but it says that the value of the firm is the free cash flow to the firm 1 period forward, divided by the WACC minus the growth rate, and the value of equity would be free cash flow to equity 1 period forward, divided by R minus G. Now, about the only thing that I would help you out with is you could say that the value of equity, if you had to solve for this, you could take the free cash flow to the firm 1 period forward, divided by, WACC minus G, and if you subtracted out the market value of the debt, then you could actually solve for the equity. We saw that before, but I just thought I'd write it down for you just one more time in case they switch this around on the exam for you. I want to make sure that you've got it. Okay, so let's look at the excess earnings method. This is, again, kind of that approach that's similar to the residual income model. And what it tries to do is it says, you know what, the firm has somehow generated earnings that are above what we would expect given different assets on the balance sheet. And so we're going to plug or figure out what that incremental earnings are, and then we're going to capitalize those. So this is kind of how it works. on the balance sheet we have working capital. In this case, we have $500,000 of working capital. We also have plant, property, and equipment, PP&E, long-lived fixed assets of $2 million. Okay? Now, as a normal corporation, you would expect that your working capital is going to provide some rate of return. And if you look down here, let me get my highlighter. The rate of return that I expect on my working capital, I need to get the highlighter, is 5%. Okay? So working capital should provide me a rate of return. It's an asset. I need to get a return on my asset. In this case, it's 5%. Now, my long-term fixed assets provide me a 10% rate of return. Okay? Now, notice that we've got normalized earnings here of $235,000. What we're going to do is we're going to find out, all right, if I take my 5% rate of return times my working capital, I should get a certain rate of return of earnings. My fixed assets of $2 million are going to provide me a 10% rate of return. We'll figure out how much earnings that is, and we'll subtract those two values from that 235 of normalized earnings, and I'll figure out what is the excess earnings that are being produced by something that's not on the balance sheet. It could be an intangible asset. It could be a patent that hasn't been recognized. It could be management superiority, brand name and identity recognition. It can be a franchise, a competitive advantage, a product differentiation, a moat around the business. Okay? So then what we're going to do is we're going to take that incremental normalized earnings that isn't attributable to the working capital and the fixed assets, and we're going to apply the Gordon growth model on it to figure out what the value of that asset would be. We'll add back the working capital and the fixed assets, and I'll tell you what the value of the firm is. All right, so like I said, we're going to take 5%, the return that we would expect as an organization to earn on my working capital, times the $500,000 in working capital, and that's going to generate $25,000 of normalized earnings. We do the same thing with the long-lived fixed assets. 10% is what we'd expect on our $2 million investment, so we expect to get $200,000. So, if you notice, we took the normalized earnings of $235 minus the working capital return of $25 minus what we got on our fixed assets of $200, and it leaves us a residual amount of $10,000. Now, if you go back to the previous slide, it says that the growth rate of residual income is 4, and my discount is 20. So now what I want to do is I want to take that $10,000, which if you think about it, whatever benefit the intangible has on the balance sheet, it's going to continue to provide a revenue source, or not a revenue source, but a residual income source out into the future. So we're going to take that as kind of our recurring cash flow in the Gordon growth model. So if you notice on the next slide, we're going to take that recurring amount of $10,000, growing at 4% a year, divided by kind of like the Gordon growth model, R minus G, and our discount rate for the intangible was 20%, and the growth rate was 4. We know that the value of the intangible asset in this case is $65,000. So when we put this all together, we say the value of the firm is our working capital of $500,000, $2 million in long-lived assets, plus the 65 of intangibles that we don't see on the balance sheet, to get a true value of the firm of 2.565. That differs from what we originally thought we saw on the balance sheet of $2.5 million with just the working capital and the long-lived assets. So there is a hidden asset here when we work through the excess earnings method example. So in a way, this is actually kind of a very cool way to look through things. All right, now, again, remember we're dealing with a private firm, and in private company valuations, sometimes we have to take a discount for certain elements, okay? And so the discounts occur because with larger firms, they're going to have greater diversification of their businesses, more market exposure, less sensitivity to downturns, maybe more managers, so there's just not one person pulling the triggers, they don't make as many mistakes, and so there tends to be size discounts and size premiums. Larger firms have premiums, generally, and smaller firms will have discounts, okay? The other thing is availability of and the cost of debt. Smaller firms generally are not going to have as much access to the capital markets, and as a result, the cost of debt, if they have to go to a bank or to somebody else to borrow money, is going to be a little bit tougher to get and probably have a little bit higher cost. Now, the other tends to be whether you're looking at in an acquisition, if you're the acquirer or the target. And the point here is, if you're the acquirer, when you're doing the discounted cash flows, You want to make those cash flows as they normally are and use the discount rate of the actual firm that you're looking at, not your discount rate of your firm. Because if I'm a larger, more mature, publicly traded firm buying a private institution, well, I don't want to use my WACC because my WACC is probably going to be a little far less than a private company. I actually want to discount those cash flows by the risk that is related to those cash flows. Okay? So you have to be careful as to whether or not you're the acquirer in that case and how you value that business versus if you're the target. Now, if you're the target, you have to certainly make your firm look a whole lot better, and by decreasing that discount rate, you make the valuation look bigger. The other thing that is a problem is what's called projection risk. Obviously, with publicly traded firms that might have longer histories, the projections might be a little bit easier. Privately owned firms trying to make projections, there's certainly a lot more room for error, therefore increasing a projection risk. And again, we have to figure out at what life cycle stage we might be in. Now, we certainly have also looked at multiple ways of coming up with discount rates. We've seen the capital asset pricing model, where we have the risk-free rate plus the systematic risk factor beta times the equity risk premium, or the expected return on the market minus the risk-free rate. Well, if you're a publicly traded firm, certainly you can figure out what your beta is, your volatility of your stock in the market divided by the volatility of the market. But with your private firm, coming up with a beta is very difficult. Now, there was a reading called Return Concepts where we were able to infer a beta from publicly traded firms, where we basically took a publicly traded beta, we unlevered that beta, and then re-levered it for our public or our private firm and kind of inferred from market comparables how to come up with an adjusted beta. Now, that is one thing that you can do. Well, again, you're trying to kind of tweak public to private, so that's, again, a challenge. So in a way, that's kind of like an expanded CAP-M. Now, in the build-up approach, you maybe not want to go out and look for systematic risk, but you look at maybe other comparable firms that have publicly traded debt. And you might add to your basket what the yield to maturity on that publicly traded debt might be. Maybe it's 5%. And then you add an equity risk premium, another 2, and then a company-specific risk premium, another 1, to get a whole discount rate of 8%. If the firm has bonds or yields that you can use, you can certainly try to use that. So again, there are certain premiums for the size of the firm. Generally, the smaller the firm, the greater the risk premium. Company-specific risk factors, maybe a lack of diversification would require a greater risk premium. And certainly if the industry is much more sensitive to economic cycles and downturns, there might be an industry risk premium. Or maybe the industry is still unproven and doesn't have much of a track record. You may have to increase the premium there as well. Now, in estimating the WACC, that creates a very difficult approach too, because most private firms don't have much debt. Public firms do. So this becomes really an exercise in figuring out what the cost of equity is. Because, as I said, public firms have far more debt capacity and lower costs, whereas a private firm doesn't. Now, also, how do we figure out what is the current versus the optimal capital structure for this private equity investment or this private investment in a firm? So the current capital structure, maybe again because it's in the very early stages of the company life cycle, might be all equity financing, but sooner or later you might gravitate, if you make an acquisition or change management or grow the firm and diversify, you might be able to pull some bond structure, some fixed income structure, debt structure into the business. And therefore you then got to figure out what is the optimal structure there, and then that would impact the WACC. If that impacts the WACC, that's going to certainly impact the discounted cash flows and the value of the firm. So far what we've done is we've talked about different income approaches. We talked about cash flows, how to adjust those cash flows, but this one is much more of a relative valuation approach rather than the absolute valuation approaches that we've seen. And so in these market approaches, these are like the relative PE multiples. And there's 3 different ways to do this. One is a guideline public company method. And so what you can do is you can say, well, I've got my private firm. I'll look out to the external world of publicly traded firms and look at their market multiples. Well, the challenge with that is that you got to look for firms that are in the similar industry, certain industry classification codes, and are very similar to your own individual business. And that can be a fairly large challenge. If that doesn't work, you can go out and look for recent transactions that have been done. So whether they be public transactions or private transactions, if you can get that data, would be helpful to infer how other deals have been done. And you can kind of use a real estate example here. You can look at other sales multiples of properties that have been done, which again are not public, but they're private. And once they're recorded at the courthouse, you can kind of get that data. But it's the same kind of thing. You look at what transactions have been done and infer the value from there. Or you can look at, rather than multiples, just what other prior transaction methodologies that they've used, whether they're price to EBITDA or the market value invested capital to EBITDA methods, and use those kinds of comparables to infer what the value of your firm might be. And again, all of these take a lot of inference, a lot of trying to do the guesswork, because you've got public versus private, and they don't always necessarily match, particularly if you've got a very early stage company that hasn't got any comparables in the marketplace to it. So again, let's kind of go through each one of these just separately. The guideline public company method, you're looking for multiples of publicly traded firms. And there's plenty of data. Again, is the advantage. The problem is you have to find comparable firms in the same industry that have maybe not as much diversification as your private firm. And again, the comparability of the data. And if you've been through any financial statement analysis, you certainly can recognize that even in public firms, finding comparables between one another is very difficult. To go from a public to a private firm, even more of a challenge. So the disadvantage is very significant in this case. So the next slide talks about the control premiums with a guideline public company method. You might have to figure out, is this a control purchase that we're looking at? Is it a total firm purchase? And so the transaction type can affect what control premium. So if you're going from a marketable minority interest transaction to a controlled transaction, where again you have those privileges of control that we talked about, you're going to pay a premium. But if you buy the entire firm, total ownership, again, that's going to take a whole nother premium in addition. Industry conditions. If the industry is growing and hence is unstable, certainly it might require a premium. If it's volatile and uncertain, it could be requiring a discount. How the deal is going to be done. Are you paying cash? Are you doing a stock swap? Are you financing it with debt? All those other types of issues, again, will affect the company-public method approach. And how reasonable is that the transaction will get done? The conditions in the markets that will allow it to get done, whether or not both parties were going to see the transaction go through, all the other tests of reasonableness can actually apply to how that firm will be valued. Again, it's an uncertain marketplace.